Here's an easy question for you. How do you calculate the net working capital of a business, which is used in the unlevered free cash flow calculation? To get net working capital for the free cash flow calculation, you add up all non-cash current assets and subtract all non-interest-bearing current liabilities. So net working capital would equal accounts receivable plus inventory plus prepaid expenses and other current assets, less accounts payable, accrued liabilities, and other current liabilities. A common mistake that a lot of students make is that they assume that cash and cash equivalents is included in the net working capital calculation in addition to current long-term debt, which is due within the next 12 months. And so it's important to remember that the net working capital calculation, you add up all non-cash current assets and subtract all non-interest-bearing current liabilities. So why is an increase in net working capital considered a use of cash and therefore being subtracted away when we calculate free cash flow? Well, non-cash current assets are considered a use of cash as it ties up liquidity in accounts receivable, inventory, prepaid expenses, and other current assets. Conversely, non-interest-bearing current liabilities are considered a source of cash because it defers the use of liquidity and therefore frees up cash for other business needs. So if the difference between the two, referred to as net working capital, increases, the amount of cash tied up in non-current assets increases and is thus a use of cash. If net working capital were to decrease from period 1 to period 2, then that is a source of cash and it would be added to the free cash flow calculation.